What if I told you that most people are losing thousands of dollars every single year, not because the market is bad, but because of mistakes they keep making over and over again? Today, we're going to reveal the 7 most common investing mistakes that are quietly destroying your wealth. Whether you're just starting out or you've been investing for years, chances are you're making at least one of these mistakes right now. And the scary part, most people don't even realize they're doing it. By the end of this video, you'll know exactly what to avoid and what to do instead to protect and grow your money. So let's get straight into it, because mistake number 3 alone has cost average Americans over $50,000 in lost returns. You do not want to miss this. Stay with us until the end, because we'll also share the one golden rule that the wealthiest investors in the world follow. And it's simpler than you think. This could genuinely change the way you think about money forever. Let's begin. Mistake number 1, trying to time the market. This is one of the most dangerous habits an investor can have. Every day, millions of people sit in front of their screens waiting for the perfect moment to buy or sell. But here's the truth that Wall Street doesn't want you to know. Nobody, not even the experts, can consistently time the market. Studies show that if you missed just the 10 best days in the stock market over the last 20 years, your returns would be cut in half. Think about that. 10 days out of 20 years, the investors who win long-term are the ones who stay in the market, not the ones who try to jump in and out. Mistake number 2, putting all your eggs in one basket. You've heard this before, but most people still ignore it. Investing all your money in one stock, one sector, or one asset class is financial suicide. When that one investment crashes, and eventually it will, you lose everything. The smart move is diversification. Spread your investments across different sectors, different countries, and different asset types. Stocks, bonds, real estate, index funds. This way, when one area drops, others hold you up. Diversification is not just a strategy, it's your financial safety net. Mistake number 3, and this is the big one, emotional investing. This single mistake has cost average Americans more than $50,000 in lost returns over their lifetime. When the market drops, fear takes over and people sell. When the market pumps, greed takes over and people buy at the peak. This is the exact opposite of what successful investors do. Warren Buffett, one of the greatest investors of all time, said it best: be fearful when others are greedy, and greedy when others are fearful. The market will always go up and down. That's normal. That's how it works. But when you let your emotions control your decisions, you lock in your losses and miss out on the recovery. The investors who became wealthy didn't panic during the 2008 crash or the 2020 crash. They stayed calm. Some of them even bought more. The solution is simple but not easy. Create a clear investment plan before the market moves and stick to it no matter what. Remove emotion from the equation. Invest with your head, not your heart. Your future self will thank you for it. Mistake number 4, ignoring investment fees. This one is silent but deadly. Most people never read the fine print on their investment accounts. They don't realize that a 1% or 2% annual fee might sound small, but over 30 years, it can eat up hundreds of thousands of dollars from your retirement. Let's put this into numbers. If you invest $100,000 and your fund charges 2% per year in fees versus a low-cost index fund charging 0.1%, the difference over 30 years at 8% market returns is over $200,000. Yes, $200,000 gone in fees. Always check the expense ratio of any fund you invest in. Look for low-cost index funds. Vanguard, Fidelity, and Schwab offer excellent options with extremely low fees. Don't let silent fees rob your future. Mistake number 5, investing before having an emergency fund. This is a mistake that can destroy everything overnight. Imagine you invest all your savings into the market and then suddenly you lose your job or face a medical emergency. You're forced to sell your investments at a loss just to cover your bills. Before you invest a single dollar, make sure you have 3 to 6 months of living expenses saved in a liquid, accessible account. This is your financial foundation. Without it, one bad event can erase years of investment progress. Mistake number 6, chasing hype and trending stocks. We've all seen it. A stock goes viral on social media. Everyone starts talking about it, and suddenly millions of people pour their money in right at the top. Then it crashes, and those same people lose everything they put in. GameStop, AMC, various crypto coins. The pattern repeats itself over and over. By the time something is trending on Twitter or Reddit, it's usually too late. The early investors are already selling while the late crowd is buying. Successful investing is boring. It's consistent. It's not about finding the next hot thing. It's about building a solid, diversified portfolio and letting compound interest do the work over time. Mistake number 7, starting too late. This might be the most painful mistake of all because time is the one thing you can never get back. The power of compound interest means that every year you wait costs you far more than you think. If you invest $300 per month starting at age 25 at 8% average returns, you'll have over $1 million by retirement. If you wait until age 35 to start, that same $300 per month will only grow to around $440,000. A 10-year delay cut your wealth in half. The best time to start investing was yesterday. The second best time is right now. No matter how old you are, starting today is always better than waiting for the perfect moment. Now, as promised, the one golden rule that the wealthiest investors in the world follow. It's not a secret formula. It's not a hidden strategy. It's something so simple that most people overlook it completely. The golden rule is this: invest consistently, automatically, and for the long term, no matter what the market is doing. This strategy is called dollar cost averaging. Every month, on the same date, you invest the same amount of money, whether the market is up or down. When the market is high, you buy fewer shares. When the market is low, you automatically buy more shares at a discount. Over time, this approach removes emotion, removes the need to time the market, and builds serious wealth through consistency. The world's most successful investors, from Warren Buffett to everyday millionaires, all share this one habit. You don't need to be rich to start. You don't need to be a financial expert. You just need to be consistent. Set it up once, automate it, and let time and compound interest build your future. The difference between people who achieve financial freedom and those who don't is rarely intelligence or luck. It's discipline and consistency. And now you know exactly how to apply it. So let's quickly recap the 7 investing mistakes you must avoid. Number 1, stop trying to time the market. Stay invested for the long term. Number 2, diversify your portfolio across different assets and sectors. Number 3, never let emotions control your investment decisions. Number 4, always check and minimize your investment fees. Number 5, build your emergency fund before you start investing. Number 6, ignore hype and trending stocks. Stick to your strategy. And number 7, start investing as early as possible. Every day you wait is money left on the table. These 7 mistakes are costing ordinary people hundreds of thousands of dollars over their lifetime. But now you know better. Now you have the knowledge to protect your wealth and build a better financial future. If this video helped you, please hit the like button and subscribe to our channel. We release new financial education videos every week to help you make smarter decisions with your money. And if you have a question or a topic you'd like us to cover, drop it in the comments below. We read every single one. Thank you for watching. Your financial future starts today.